Markets to Watch, sponsored by Pagetrader.com, starts now.
We go straight to David Williams. David, it's been fun working with you this week. Take it away.
Thank you. Thank you. Well, good morning, Kate. Nice to be here. We're delighted to. This has been such an incredible week. I don't know if I think anybody else you would speak to would probably tell you how amazing it has been in the markets. The volatility is about 5 times as big as it normally is, which is just remarkable. And we've made literally dozens of excellent forecasts for where the markets are going to go during the week. I do have one for you that the S&P will be trading at least up. We gave this out much earlier today when the S&P was down near 2,540. But the forecast is that the market will be trading at 2,640 at the latest on Tuesday on the upside. And so they're rallying right now as we're coming into the close today. This rally will continue into Monday or Tuesday up at 2,640 in the S&P or higher. And so, we'll be putting that together in a trade into next week.
Well, David, I have two millennials. Actually, I guess technically I have 3. And one of their favorite bands is a group called Paramore. And one of their biggest songs that I think of when I see this kind of market is "Ain't It Fun." I have a blast watching this, and I have a blast listening. You talk about the market itself. So, kind of, you gave us 2,640. Kind of give us a feel for. Obviously, the day is almost over it, but moving out, I don't know, probably past Tuesday, Wednesday. Where do you see the market going there?
Well, we're forecasting, and we've been forecasting that the market would put a bottom in both on the week of February 5th. This was done on January 29th. Both the week of February 5th, which is this week, the market would put a bottom in there, and it would also put a bottom in longer term on the month of March. So next month is the on-time month for a bottom in the S&P, and that'll correspond with the Dow as well. So once that bottom is in, then we would expect a what could be technically called a hell of a rally.
Exactly.
So,
now, going back to one of your other predictions, you mentioned the downward move in the handles on the bond. Right now, I think if me being the person I was in the background I have, what I see is the market adjusting to the potential for the higher interest rates and looking at the what we call the adjusted risk rate of return being changed just because of the fact you have rates going up and changing the risk-free rate. As you go forward, do you see an additional movement down in the bond market that could potentially cause even more ratcheting?
Yes, I do. As you know, on your program here on January 18th, and pretty much every time that we talked about bonds, on January 18th, the bonds were trading at 149.20. And we had forecast that the bond market was going to move down 7 full handles, which means 7 full basis points lower. And it would do so prior to the ending of this quarter, the first quarter of 2018. And that's a $7,000 per contract move. That means if you sold a futures contract, that's 7 handles. Each handle is about $1,000. So it's a huge move in the bonds, and it really does change the interest rate. It raises the interest rate and so on. Anyway, since the date of January 18th, the market has moved lower. Today, we made a low of 143.20. That's just 21 ticks off of being down at the 142s. And we've forecast this, of course, for our whole trading group worldwide. There's many people that are very happy about where the bonds are now because of that forecast. But as you well know, this behavior is part and parcel to the bond market having reached a blue moon extreme of low interest rates and even maintaining those low interest rates for a number of years. So now we're starting the new cycle down in the bond market, up in interest rates. And this will go on for the next 30 years until interest rates, unbelievably, will at some point be back up at 17 or 18%. Many of us may not still be worried about the bond market, if you know what I mean, at that point. But that's where we're headed ultimately is to, and it takes a long time. It's many decades. This is a very big picture thought that I'm giving you.
So to look at this, David, in another way, somebody asked me, somebody sent me an email the other day. They heard me on the air, and they wanted me to ask you about your process with forecasting and looking at different verticals. So in other words, meaning techs, you look at tech, you look at the healthcare industry, you look at housing. A lot of people look at the housing as the big indicator of some of the swings that we see, especially when you're talking about interest rates. Could you explain that process a little bit?
Yeah. The way that we approach markets, and this is a little unfortunate for some people because they feel uncomfortable with this, but we're purely technical. So we're not blending news in with what the markets are going to do. There's been always for forever, there's been this thing about in markets about whether the fundamentals are what drive the price or the technicals drive the price. Technicals being the actual movement of the market itself, studying those movements. And I think it's a wrong question. I think the fundamentals and the technicals are really two sides to one coin, and there are people, very competent people, that can do excellent work with the fundamentals. So there's nothing wrong with fundamentals, but there's equally excellent insights into the technical side of the market as well, and you can use either of those or both to make your forecast. I did make, if I may say so, when I was on, I've been on another program, a radio program, and I was on it for 10 years. And when the bonds were moving up, when interest rates were very low and the housing market crashed, fundamentally, I knew that was a blue moon. Because normally, Kate, when interest rates are very low, housing prices are high. And the reverse, when housing prices are low, interest rates are high. So in 2009, 2010, 2011, and even beyond to some extent, both interest rates and housing were strangely in a blue moon position because both of them were low. Housing had crashed, and the bond market had rallied to the stars, and interest rates were very low. So that's why we put out at that time that, and this was an unusual forecast for us, but that real estate was going to be the thing that corrected. One of those two had to make a move to regain the previous ordinary setup between housing and interest rates. And that would mean that housing would have to go up. And we indeed, over the last 6 years, have seen a tremendous rally in, not necessarily in every city and every county, but generally speaking, we've seen a really impressive return to higher prices in real estate.
Well, you also know from the Federal Reserve standpoint, you can only have so much accommodation. And I think we were at that point where we were literally at zero to negative interest rates. And speculators, developers, whoever, are going to take advantage of that. It may not be immediately, but it does happen. So ultimately, you saw that happen, too, and that increases jobs. So you end up pushing on interest rates when you get back to the point that you're trying to figure out how to get the economy moving. You mentioned something a second ago about the potential for having interest rates 16, 17, 18% going forward, or 20 years out, whatever that number is.
Yes.
Does that mean we have to go back and exhume Paul Volcker to fix that, or how does that work?
We're going to find somebody that doesn't necessarily have his name, but everything runs to extremes, and this is why there are opportunities for people, young people, to understand markets, understand that the nature of markets is to run to extremes on various time frames, and for people to understand that when those extremes happen, there really is a huge opportunity for them in that particular market. And given the fact that there's 35, 36, 37 different commodities markets and many, many other physical markets, I think it would be great for young people to know that in their lifetime, there's going to be extremes reached that they can take advantage of in a much more major way than simply trading in and out like we do, but something that really could change their life, like buying real estate when both real estate and bonds were at a low price. Interest rates were low and real estate were low.
Right, and as you said, you haven't seen that. And how long has that been? And learning that for somebody who's a millennial, as Ed was mentioning his kids, this is perfect for them as they turn that corner.
No, right, and I really feel strongly that the youth of today, putting politics aside, putting aside everything that people could argue over about where the direction of the country is going, I think it would be massively wonderful if we could teach kids of this, the 18-year-olds and millennials and so on, more about the nature of markets so that in their lifetime, when these things happen, when these extremes get reached, they can actually do something for themselves and others and do great things, because the markets are going to go there anyway. Why not have some understanding and better your life, better your family's life, and so on, and take advantage of these. And I'm hoping that if we can't do that for people, that somebody will at some point to make a better society for people, because people can take advantage of these markets in a very big way when they reach extremes.
Yeah. David Williams, thanks so much. Markets to Watch will be back next week. Thank you. Thanks to a few people who made the show happen. Diamond on the technicals, Fish, the producer, Ed Baxter, fun working with you. Joe Savard, the official photographer, and the eye for sure. Tracy Brown and 8:15. You're paying. That's all I'm saying. Have a great weekend. Michael Yorba's back next week on CEO Money.